So let's take a deeper dive in activity-based costing. And we're going to take a closer look and analyzing, well, what are some of the challenges associated? Well, when we're doing activity-based costing, we can look at a couple of different kinds of capacity to analyze. We can look at the practical capacity. That's kind of what we're expecting to use or to execute. We can look at the actual capacity, which is kind of a ceiling. This is the maximum that we can make. And if we're fully utilized, that's the level we're going to be at. Or we can try some other estimate. Well, what we tend to want to use, because we don't want to factor in the idle time, the idle capacity, because we might say, well, we put 50,000 we expect to make. We have a capacity of 75,000. If we make only 50,000, we're not accounting for that extra 25,000 units that if we did account for those, which we probably aren't going to use. So we want to probably use the 50,000. We probably want to use the practical numbers to be associated with that. So we take a look at comparing our plant-wide rate versus a departmental rate versus our activity-based costing rate. And again, we said activity-based costing was the most accurate of methodologies to use when we're discussing and projecting activities. A couple of issues. Multiple systems are often maintained. We probably use traditional and ABC, but traditional is often used just for external reporting, because again, that's the easiest to monitor, easiest to maintain. If we actually went to a complete conversion to ABC, which we said is more accurate, it is a lot more grunt work to really do the analysis. And the auditors need to sign off and accept the use when we're doing that, which actually will add to our audit fees because they're going to spend more time reviewing the systems and doing the analysis and doing some recalculations as they go. As far as the use of our customer profitability, we can do some specific analysis for that as well. So let's take a look at customer profitability analysis. So ABC may be used for individual customers. Sometimes you want to fire your customers. You say, what do you mean I want to get rid of my customers? Well, sometimes our customers are not real profitable, or some customers we lose money with and some we make money with. And often we want to get rid of the ones we're losing, or some that take more time, effort. And we always have those customers that are, it's the Pareto principle, 80-20, 20% of our customers take up 80% of our time. Well, those 20% of those customers, we may want to part company with if they are draining resources and we are ultimately losing money on there. So customer costs can be analyzed on the cost to incur to sell as well as to service. And then we can go message to profitability to increase profitability. And we try to terminate our unprofitable relationships. So a customer graph looks like this. Once the company knows the amount of profits or losses for each customer, it can create a customer profitability profile. And we can see those that are contributions to profits. We got total profits, cumulative total profits on the y-axis. And we have got customers from least profitable to most profitable. And again, we want to focus on servicing our profitable customers. So profitability analysis means identifying the customer, the activities related to serving the customers. So we might have warranty work, we might have support, we might have design work, we might have a variety of services we provide. Some we charge for, some we don't. We prepare a customer profitability analysis, and then we're proactive. We take steps to analyze what's going on, what we're doing, and see who's profitable. And we do that based on these same activity pools and the cost drivers associated with those pools. So we look and say, well, here's the cost per activity, and the largest so in this case, the largest customer is analyzed, and we're going to do that in the next couple of slides. But we have visits to customers, remote contact, processing and shipping, repackaging, billing, and collection. If we have customers that aren't paying and we got to send out more bills and we're financing them, that's a cost associated with what we're doing. So we have customer contact cost information, and we analyze this for one company, and we have data points. We have 4 visits to customer, 3 remote contacts, 6 processing and shipping activities, 2 repackaging, 3 billing and collection. So based on the activities, and we have a cost per unit. We have a total of $3,030 associated with this customer for servicing. And we're going to look and say, okay, customer sales, less cost of goods sold for gross profit. Take that 3,030 activity cost, and our customer profitability is 13,970. Out of the total, that's 17.7 contribution to the customer profit. Lower profitability should be flagged and efforts made to correct the situation or terminate the customer. The ideal is, all right, how do we make this more profitable? And if we can't make it more profitable, and then actually, is 17.7 good? I have no idea until we compare it to other customers that we are servicing and participating in. And then we can make those decisions as we go. Finally, activity-based costing versus activity-based management. Just have a couple of slides left, and I'm going to share those now. So we want to maximize the value of activities while minimizing their cost from the perspective of the final consumer. And this is where management needs to focus their attention. What are the most important activities to create value to the customer? And that's the analysis we want to do. We want to take a look at the things that basically contribute value in the process. So part of the business performance management solution, we have a couple different kinds of management: profitability management, performance measurement, financial management, sustainability, and human capital management. One of our last projects in this course talks about ESG and people, planet, profit. We are taking a look at the human side, the sustainability side, community, people, as well as profit, bottom line profit. So the 4 generations of activity-based costing. First generation, accurate costing systems were designed to cost and profit drivers geared towards activity-based management. Multi-industry extended the value chain application. That value chain is, where do we add value in the process? What are we doing that adds value? Are we making cornflakes? Well, we're adding value when we're going in and saying, okay, we're mixing the flour, the sugar, the raw materials going in, then we're baking it. That contributes to the value. We're ultimately packaging it. Yeah, that contributes to the value as it goes out the door. But is inspection contributing to the value? Not directly. Do we have other overhead items that may or may not be contributing directly to the value chain of associated? Well, we need to monitor and be aware of those. Third generation is sustainability, and that's getting a lot of press, a lot of direction. And finally, fourth generation, integrated performance management solutions and mega models and analytics. Data analytics is where it's at. We were doing in financial, did some Power BI stuff, Power Business Intelligence stuff. We are looking at the analytics. We're getting more and more data to help us make decisions and help us be more profitable. So that concludes this particular module, and we will look forward to continuing onward and upward and taking a deeper dive, and a few more classes to go, a few more modules to get taken care of. We'll see you soon.